Hello, everyone, and welcome back to part 5 of week 2. This is BFW 2401, and we are talking about the interest rate risk. Now, we are talking in part 5 about the repricing model. If you allow me to share, so we will go now directly to the repricing model. Now, as I said in the beginning, when we talk about it, we finished the reinvestment risk, refinancing risk, and then we talked about the impact of the interest rate on earning or capital. Repricing model deals only with the net interest income, which is deal with the earning. That means it only deals with the income statement, which is a little bit different from the repricing model that we will discuss later on. Let me continue. So this is a repricing model. And as I told you, repricing model measures only the impact on the net interest income when the level of interest rate arises or falls over a particular period of time. And this is, of course, when we have different horizons and maturities for the assets and the liabilities. When the interest rate changes, then there will be impact if we have different maturities for an asset. The assets, for example, I take 1 million of assets of deposits for 1 year and I invest it for 2 years in a loan. Now, if there is a change in interest rate, there will be what we call refinancing risk, as I explained it before. Repricing model try to actually address this issue. The iteration model is different, and actually we will deal about it later on, but it takes into consideration the market value, the cash value of assets and liabilities. We don't have to worry about it. Let's go with the repricing model. This is the formula of the repricing model. You have to get the risk-sensitive assets and risk-sensitive liabilities. Now, someone would say, oh, what is this risk-sensitive assets and what is risk-sensitive liabilities? To define it from now, risk-sensitive assets are those assets that will be changed if the interest rate, they are sensitive to the changes in the interest rate. Risk-sensitive liabilities, to define it also, those are the ones that are sensitive to the changes in the interest rate. So we have to, I will explain what is this and what is this to get the dollar gap, which is the difference between those two sensitives. But then when we take the difference in the gap, we multiply it with the interest rate. Now, this interest rate can be plus or minus or even zero. Whatever it is, there will be, as I told you, either it can be plus or minus or even zero. And that will actually change the net interest income. So we will take this out now, and we come back to our model. Let me define first what do you mean, and this is a very important issue. How do you define a rate-sensitive asset or a rate-sensitive liabilities? Let's start with the rate-sensitive assets. They are either floating rates, all those assets that have, which means you give a loan and it is floating, which means the loan will be, the rate of the loan will change if the market interest rate changes. Now, we don't do that for all loans. This is actually to business loans. But actually for housing loans and some other loans, they can be fixed. Or if they are short-term assets, which means they can take less than 1 year. This is the definition of it. Now, the other thing is the maturity horizons, which means I can take risk-sensitive assets and risk-sensitive liabilities in the same bucket, which means I will take all the assets that change in 1 year and all the liabilities which change in 1 year. And the difference between them is actually, if the difference between them 0, then I don't have gap. But if there is if the difference between them positive and negative, that means they have to replace those assets or liabilities with the new rate. So please take into consideration, if we are talking about a balance sheet of 1 year, if I give you a balance sheet for 1 year and I want you to get me the risk-sensitive assets, then you will look at those. But if I give you the whole inventory of assets and liabilities, then you have to go with the maturity horizons of each asset, as we are going to explain it now. Now, risk-sensitive liabilities is still the same. Either they are short-term, and this is the names of those short terms, or it can be a maturity horizon. Now, and this is the definition of the liability maturing to be paid to the debitor or depositor in certain maturity horizon, then it's considered risk-sensitive liabilities in that horizon, since it will be refinanced at current market interest rate and therefore becomes part of the risk-sensitive liabilities and the specific horizon. Of course, we need to get all those assets and liabilities that are maturing in the same period. How can I explain this? Those horizons can be 1 day, can be 1 day to 3 months, can be from 3 months to 6 months, 6 months and more. So if you are going to work in a bank and you are assigned with a team to this type of assignment to calculate the interest rate risk using the repricing model, you have then to calculate, to classify and make a classification of each liabilities and assets that end in different horizons. So you will take all the 1 days together, all the 3 months together, 1 to 3 months together, 6 months up to 1 year together, and you will add them up as I will explain it here. Look, for example, here, this is horizon. This is 1 day. This is 3 months. This is 6 months. So I can tell you now what is the gap. The gap, which means if I talk 1 day, I'm telling you now, all the assets that will mature in 1 day is 50. All the liabilities that will mature in 1 day is 25. So actually the gap for 1 day is 25. What about from 1 day to 3 months? Actually, they are 40 if you take the 3 months. But if you take it from 1 day to 3 months, which is this two, they will become minus 30. So this is 1 to 3 months is minus 30. You take the assets and liabilities from 3 months to 6 months, you will find the risk-sensitive asset 50, risk-sensitive liability 80, minus 30, and so on and so forth. Now, if I ask you what is the average interest, if the interest rate increased by 1% over the next 3 months, which is this one, this horizon, what will be the impact? I just use the repricing model. The repricing model, I have to get the gap and multiply it by the change in the interest rate. Let me see whether we can do this. What is the gap? It is minus 30 million. And what is the change in the interest rate? Is 1%. So the impact will be now is 300,000. This, if the interest rates change in this horizon by 1%, the bank will make losses, or his net interest income will decrease by 300,000. Now, we can have also a different way, which we can take not only the gaps as we did there, but actually we can take not only the gaps, but we can take actually, we can take the C gap, which is C gap from now, please know it as accumulated gap, which means now for 1 day, 25. But 3 months is 30. So to get the accumulated gap for those two horizons, you will have to decrease this. This is 25. and then you take it from the 25, this is accumulated gap, for 1 day, you take it from this, you will get -5. Now, if you want to take these 3 horizons up to 3 months, actually you take this, which is of the 3 months, and you decrease it from this, and you can see it's -35, and so on and so forth. So if I ask you, what is the impact on this bank if we take accumulated gap up to 1 year? You already know it's -65 million. This is the gap, the dollar gap. You multiply it by the increase of the interest rate of 1%. So the question will be, assume that change in interest rate 1%. What is the effect of is the average rate change that affects assets and liabilities, which can be priced with 1 year. 1 year means from here until 12 months, which is actually up to here, which is the blue. So we just multiply 65 by 1 million. Now, by the 65 million, which is 650,000. Now, if this changes, if I want to calculate the cumulative gap, the bank will lose around 650,000 if the interest rate changes during this year up to 1 year, which means from day one to the 12 months to the end of the year, no changes, it's still the same. So it's -65. We have been seeing a lot of changes in the interest rate in Malaysia after the what we have seen now in the US during this time. I tried to bring those numbers and play with it again. So this is the gap. This is just the same example. And this is the accumulated gap. Now, as you can see, if you want to take it for, I just multiply this by 1%. This is the change in the interest rate. And if it is for, this is a cumulative gap for 1 period. This is for the 3 months. This is for 1 year. If you want to take it up to 5 years, assuming no change, it's this one. The number is in million. And over 5 years, it will be 0. So this is if you want to play with it. If it is 2%, for example, and you want to play with it again, you can see the change will change again. You can make it -1%, for example, -1% instead of the increase. As you can see, the impact will change. It's only minus here, but then the rest is there. And this is because the cumulative gap is changing. Now, this is how we do it. And this is how we calculate it. Now, the industry also using this one. For this is Westpac, one of the big 4 banks in Australia. And they have, for 1 year, the assets and liabilities, and they can get the 1 year gap. And this is they calculated from 94 to 2008. Of course, there is new data. We will try to use, if we can get more data, we can calculate in class more than that. You don't have to worry actually about this. I'm not using it, which is this one, the 1 year gap over the total asset. You just calculate this over the total asset, but you can ignore it for the time being, no problem. Now we come to the end of this model, but actually we want to see the advantage and disadvantage. For sure, this has too many disadvantages, but it's easy. Actually, it's easy. It's easy to use, and it's simple, and it can provide information, but it has weaknesses, and those weaknesses, we have to look at this. The market value, they don't consider it. There is something called over-aggregation. There is something called run-offs. There is something called, it ignores balance sheet, for sure. It ignores all of the balance sheet items. Let me look at those. What do we mean by market value? See, interest rate changes can, you remember when we talked about the impact on capital? Repricing model does not care about that. It only cares about what's happening in the interest income. So if you are holding all those assets, as I told you, 100 million of bonds, and the interest rates goes down or up, and the price of the liability of the assets, the price of the asset goes up or down, which is the present value, actually repricing model does not capture that. It only captures the difference between the assets and liabilities and its maturity, calculate the gap and multiply it by the interest rate. This is one problem. The other problem, look, the changes, the gap itself, which is between the risk-sensitive asset and risk-sensitive liabilities, can be very volatile, which means, look at this. And month 1, it could be 0. Month 2, it could be 0. Month 3, it can go to, this is the gap, plus 50. And month 4, it can still 50. But in month 5, it can go to minus 50. And this is minus 50 in week 6, in month 6. So if you are using this horizon, up to 6 months, actually you are ignoring what's happening during those months. You are just taking what's happening in the 6 months, especially when you take single gap. If you take accumulating, you are talking about minus 5. And you will do calculation of your interest rate risk based on the gap of minus 50 for the first 6 months, which actually there has been so many. So this averaging of over aggregation is a problem in this model. It doesn't take each one and each asset and discount it by itself and add it up to the rest. The other thing is runoffs. See, when we receive the assets in one maturity, for example, I'm talking about this maturity. This is maturing 50 and the liability maturing 50. This asset 50, I take it and I start actually invest it again with the new rate. The repricing model does not capture this issue. For example, if I'm taking from 1 day to 6 months, actually I'm calculating only when I take here, for example, for 1 year, for 1 year, which is, we talked about the 65. But actually during this period, we have received 50 and invested in the new rate, and it has its own interest rate risk. And this one has been taken and reinvested again, and it has its own. We don't calculate that. We don't calculate that. Repricing model actually does not capture the amounts that received during the period or that horizon and reinvested in the new rates. This is what we call the runoffs. Off balance sheet is a very clear issue to explain, and actually we are talking only about the assets and liabilities that is in the balance sheet. Out of the balance sheet, changes like loan commitments and other things, we are not taking it to consideration, and therefore this is the fourth weakness. I am done here and I will stop sharing. Thank you very much, and I hope you find the repricing model better. Easier. We will talk now about the duration model in a while. Thank you. Bye-bye.